Okay, so for our deep dive today, picture this. You have a teenage boy, a dropout, who walks into a small brokerage office.
Right.
He has zero connections, no degree, nothing. And he somehow manages to make and then lose millions of dollars before he even turns 30.
And not just once. He
Yeah.
made and lost several fortunes. It's an incredible story.
It really is. We are, of course, talking about the speculator Jesse Livermore from Edwin Lefèvre's classic Reminiscences of a Stock Operator. But we're not just here to talk about the Roaring Twenties. We're diving into the sources to figure out why this book is still, a Bible for trading psychology 100 years later.
Well, what's so fascinating is that Lefèvre's account, it completely strips away this idea that the market is some kind of intellectual puzzle.
It's not a math problem.
Exactly. The sources paint Wall Street as this raw psychological battlefield.
That's a point that really stood out. We tend to think the smartest guy in the room is the one who wins, right?
Yeah, but the book argues that high intelligence can actually work against you if you start arguing with what's actually happening.
You can't argue with the tape.
You can't. The market just doesn't care about your opinion or your thesis. If the price is going against what you think should happen, the market isn't wrong. You are.
There is a specific idea in the book that gets at this, the pivot point.
The pivot point is crucial. It's this idea of waiting for the market to confirm you're right before you put your money down.
So he wasn't just guessing.
No, not at all. Livermore wouldn't just buy a stock because it seemed cheap. He'd wait for the price to break through a key level. The psychological barrier, really. And that was his confirmation.
He was testing his theory. But the part I found really counterintuitive was the whole discussion about sitting.
Ah, yes. You mean the story of Old Turkey.
Exactly. It's probably the most famous part of the book for a reason. You have this old trader, Old Turkey, and he just refuses to sell in a bull market.
Even when everyone is telling him to take his profits on the small dips.
And his big line, the core lesson is, it was never my thinking that made the big money for me. It was always my sitting.
My sitting. It sounds so simple, so passive.
It does.
But it's the hardest thing in the world to do. What Lefèvre is getting at is that being right about a direction is actually pretty common. Lots of people can pick a winning stock.
But to actually hold on to it.
To sit tight and let that winner run without getting panicked or greedy, that's incredibly rare.
Because your human instinct is to just grab the profit as soon as you see it, right? To just take the money and run.
Exactly. The source material is clear that traders get their emotions completely backward. They hope a losing trade will come back, so they hold on to it.
Instead of fearing it.
Right. And they fear a winning trade will disappear, so they sell it way too early. They cut their winners and ride their losers.
Which brings us to the book's, its central argument, really. If we all know what to do, but we do the opposite, who are we actually fighting against?
The enemy is you. It's that simple. It's not the market. It's not the news. It's not the algorithms. The greatest opponent a trader will ever face is their own human nature, their own fear and greed.
And Livermore's own life is just. It's the ultimate proof of that, isn't it? He went broke over and over again.
That's the critical context. This man literally wrote the rules on risk management and discipline. He knew all of this.
But he still broke his own rules.
Constantly. He'd get arrogant after a big win, or he'd overtrade, or he'd fail to cut a loss when he knew he should have.
It's kind of terrifying. You can have the perfect system. You can know all about pivot points and sitting. But if you lose control for one afternoon, you can wipe out years of work.
Fortunes are built in that quiet, patient sitting. But they're destroyed in seconds of impulse.
So this book isn't really a guide on how to trade, is it? It's more like a warning label.
It's a study on the limits of our own rationality.
It really makes you think. We spent all this time searching for the perfect strategy or the next big thing. But if Jesse Livermore, maybe the greatest trader of his time, couldn't even master his own psychology despite knowing all the rules, well, it leaves you with a pretty big question. Is financial success really about mastering the market? Or is the entire game just about mastering yourself?
So we are looking at a 14-year-old boy. He's just managed to get through 3 years of arithmetic in a single year of school.
Incredible.
He doesn't have a business degree, no wealthy parents. He's just standing in this chaotic room in New England with a piece of chalk.
And he's about to figure out how to bankrupt a casino just by staring at a wall.
It sounds like fiction, doesn't it?
It really does. But this is the genuine origin story of the boy plunger. And the setting, it just strikes me immediately. This is not some polished boardroom.
No. It's a customer's room in a brokerage office, which sounds a bit polite for what it actually was.
Oh, it was frantic. You've got the ticker tape machine just clicking away in the corner, spitting out this ribbon of paper.
Oh, the stock crisis.
Right, and you have men shouting orders, smoke everywhere, and in the middle of all of that, you have this kid. He's the quotation board boy.
Which sounds kind of like a glorified secretary, but the job itself was really physically demanding.
Absolutely. His job was to grab the numbers being shouted from the ticker and just, write them on this massive chalkboard for all the customers to see.
He had to be fast.
Super fast and accurate. But, the key thing is he couldn't stop to think.
But he did think. And that's the whole story, isn't it?
That's the twist. Most people would just see a blur of numbers, but he started seeing something completely different.
And that's the heart of this deep dive, really. How does a child with no formal training, no insider info, how does he crack the code of the stock market?
It's because he had this very specific, almost strange relationship with numbers. He didn't just write them down. He absorbed them.
Yeah, the sources mention he had a phenomenal memory. He could remember the opening and closing prices from the day before without even looking.
Right, but it was deeper than just memory. It's about abstraction. Think about the other men in that room.
Okay.
When they saw a quote for, say, Burlington Railroad, they were thinking about trains, factories, earnings, dividends, the actual business.
And the boy.
To him, the names were just labels for a number. He didn't care if Burlington was a railroad or a bakery. He says it himself. He didn't care why prices moved.
He didn't read the news or listen to rumors.
Nothing. He just observed that they moved.
That seems so counterintuitive. We're always told to do our research, understand the fundamentals.
Yeah.
Isn't ignoring the why just dangerous?
For traditional investing, yes, of course. But he wasn't investing. He was basically pioneering what we now call technical analysis, reading the tape.
By ignoring the why, he took the emotion out of it.
Exactly. If you hear good news about a company, you want the stock to go up. You might ignore the signs that it's actually going down. He had none of that bias. He was just looking at pure behavior.
So what does behavior even look like in a list of numbers?
Okay, so imagine a stock is trading at, say, 80. It goes to 82, drops back to 81, then back to 82, keeps bumping its head against 82, but won't go higher.
Right.
Then all of a sudden it breaks through to 83. He started to notice that whenever that specific little dance happened, the price would almost always shoot up to 85 or 86 right after.
So it's like finding a glitch in a video game. If
Yeah.
you press A, then B, then A again, you get a power-up.
That's a perfect analogy. He called them habits. He realized that stocks have personalities. Some are volatile, some are steady. But the big thing was that price movements weren't random.
They repeated.
And if they repeated, they could be predicted.
He called this clocking the stock.
Yes! He started building this mental dope sheet. He'd look at the tape and think, okay, sugar is acting exactly like it did last Tuesday before it dropped 3 points. He was just cataloging thousands of hours of data in his head.
But, having a hunch is one thing. Putting money on it is something else entirely. And he didn't have any money.
And this is the part I think is so instructive. He didn't just jump in. He created a test. He bought a small notebook.
The notebook experiment.
Exactly. For 6 months, he didn't make a single trade. He would just write down the stock, the price on Monday, and then based on the patterns, he'd write down where he thought the price would be on Tuesday or Wednesday.
It's basically paper trading.
It is, but the discipline there. He's 14. Most people would get impatient after a week. He did it for 6 months, not to fantasize about being rich, but, and he says this so clearly, I was interested in verifying whether I had observed accurately.
He was testing his algorithm.
He was scientifically validating his edge. He wasn't going to risk a single penny until that notebook proved he was right over and over again.
So the notebook gives him the green light. He knows he can do this. And now we get to the first trade, which, ironically, starts with the one thing he grew to hate.
A tip. It does. An older office boy comes up to him with a sure thing on Burlington stock and wants to pool their money.
Now, most people, if someone whispers a hot tip, you either trust them blindly or you ignore them. He does neither.
No, he treats the tip like a hypothesis. He doesn't trust the kid's word for it. He goes to his data.
To the notebook.
To the notebook. He checks the recent behavior of Burlington and sees that, yeah, according to his own system, it is acting like it's about to rise.
So he takes the bet, but not because of the tip.
Not at all. The tip was just the trigger. The decision to invest was 100% based on his system. He gave that kid every cent he had in his pocket.
And they go to a bucket shop. We have to stop and explain this because a bucket shop is not the New York Stock Exchange.
Oh, not even close. It's a completely different beast. A bucket shop is, well, it's basically a betting parlor.
So you're not actually buying a share of the railroad.
No. You are betting against the house, the shop owners, on what the ticker tape is going to say next. You put down maybe $10, they give you a ticket. If the price goes up, you cash out, and they pay you from their own pocket.
But if the price goes down,
They keep your $10.
and I'm guessing they're designed for people to lose.
Of course. They offered huge leverage so you could control a lot of stock with very little money. But if the price dropped even a tiny bit against you, poof, your margin was wiped out instantly.
But the boy, he didn't lose.
2 days after that first trade, he cashed out. His profit was $3.12.
$3.12. It sounds like nothing.
I know, but back then, that was real money for a kid. More importantly, he said, it was proof that my system was right. That $3 was the validation of 6 months of work. It was the spark.
And once that spark is lit,
Yeah.
he becomes a machine.
Huh?
Trading on his lunch breaks.
Yeah, he started treating the bucket shops like his personal ATM. It wasn't gambling to him, it was just executing math. And he was quickly making more in his 1-hour lunch break than he made all week at the brokerage.
So he quits the job.
He quits, and by the time he's 15, he has $1,000 in cash.
Which, in that era, is an insane amount of money for a teenager. It's like a kid today having, what, $30,000 or $40,000 in cash.
Mm-hmm. And that's where the conflict starts. He brings the money home to his mother.
And she freaks out.
She completely freaks out. She thinks it's gambling. To her, money comes from hard work, from labor. You don't get rich by staring at a chalkboard. She wanted him to put it in a savings bank and just stop.
But he didn't see it as gambling at all.
No. And this is such an important distinction. To his mother, the outcome was random. To him, it was the result of a process. He said, I wasn't thinking about the money. I was thinking about being right.
Being right. The money was just a way to keep score.
Exactly. If he made money, his math was correct. If he lost, his math was wrong. So placing a bigger bet wasn't about being braver. It was about being emphatically right.
But there's a problem with always beating the house.
The house hates it.
Yeah.
The bucket shop's entire business model depends on the fact that 99% of people are just guessing. They're emotional, they lose. When some kid comes in and wins 80% of the time, the shop is losing money directly from its own safe.
So they ban him.
They started telling him to get lost. He'd walk up to the counter and the clerk would just say, nope, we don't want your business here. And that's where he gets the nickname, the boy plunger.
He was plunging in and taking their cash, so he has to go undercover.
It becomes this whole cat and mouse game. It's actually pretty funny. He starts using fake names, going to different branches, sending in friends to place trades for him.
There's that story about the short...
Big under a fake name. The manager gets suspicious and calls the main office. The head office asks, what does this guy look like?
And the boy knows he's been caught.
He knows, so he whispers to the manager, tell him I'm a short, fat man with a dark beard.
But the manager doesn't lie.
No, the manager describes him, as a kid, and the guy on the phone just screams, that's Larry Livingston. We told you not to take his business. And he gets kicked out again.
It's hilarious, but it just shows how desperate these places were. They were literally sharing descriptions of a teenager to stop the bleeding.
He eventually runs out of small shops, so he has to go to the biggest one in all of New England, the Cosmopolitan.
The final boss.
Pretty much. They were too big and too well known to just ban him. It would look bad. So instead of banning him, they decided to rig the game against him.
How do you rig a game that's based on a public ticker tape?
You change the odds. First, they made him put up huge margins, 3 points instead of 1. So he had to risk way more money on every trade. But the real weapon was the premium.
Explain the premium. This seems like the key.
Okay, so let's say a stock is trading at 90 on the tape. If you want to buy it, you should pay 90. But the Cosmopolitan told him, if you want to buy, you have to pay 91.25.
So he's instantly losing money the second he makes the trade.
Immediately. He is down 1.25 points before the stock even moves. It's like running a 100-meter dash, but you have to start 20 meters behind everyone else.
It sounds unbeatable. The edge is gone.
You would think so. But his education of the tape was so advanced, his pattern recognition so sharp, that he still beat them. He just had to be more selective, only trading on the absolute surest of patterns.
Which brings us to the sugar trap. This feels like the climax of his bucket shop years. It's less about the math and more about something else.
Intuition, yeah. He's at the Cosmopolitan. He's taken a massive position in sugar. Specifically, he is shorting it.
We should probably explain shorting real quick because the risk is completely different from buying.
Right. When you buy a stock, the most you can lose is what you put in if it goes to zero. But when you short a stock, you're betting the price will drop. If the price goes up instead, well, your losses can be infinite.
And he's short 3,500 shares. That's a terrifying amount of exposure.
He has over $10,000 in margin on the line. And the market feels soft. Everything says the price should drop. But then all of a sudden, the boy gets a feeling.
A feeling. After all this talk about math and notebooks.
And that's what makes this moment so critical. He couldn't point to a specific number. He just felt that the tape was hesitating. The rhythm was off. He said, I felt uncomfortable.
So he's standing there, 10 grand on the line, and his gut just screams, get out.
And he acts instantly. He doesn't wait for a reason. He walks to the counter, hides his ticket so the clerk can't see them coming. He watches the telegraph operator. He sees the clerk turn to listen to a message coming in, and he just knows a fix is coming.
And he jumps.
He slams his tickets on the counter and yells, close sugar, just as the next price is being called. He forces them to close him out at the current price, 103.
And what happens next?
Seconds later, I mean literally seconds, the ticker goes wild. The price of sugar rockets from 103 up to 108.
A 5-point jump in a heartbeat.
Yes.
If he had still been short.
He would have been wiped out completely. He'd have lost the entire $10,000 and probably owed them more money on top of that.
Why did it jump like that? Was it real news?
No. It was a bucket shop drive. The Cosmopolitan and other big shops, they knew traders like him were short sugar. They knew where their margin limits were. So they went to the real stock exchange and started buying up shares to artificially spike the price.
They manipulated the national market just to bankrupt the bettors in their own little shop.
Exactly. They rigged the whole game to clean out the short sellers. And it worked. Another guy in the room, Henry Williams, he was also short. He didn't have that feeling. He got completely liquidated.
So the boy survived not because of his math, but because he sensed the trap.
But here's the key takeaway. That sense wasn't magic. It was the result of the thousands of hours he spent staring at that board. His subconscious recognized a pattern, the hesitation, the subtle shift in the tape that his conscious mind couldn't even articulate yet.
It's like a pro athlete who knows where the ball is going before it's even thrown. It looks like instinct, but it's really just internalized data.
Precisely.
Right.
And that leads to this core philosophy he carried with him for the rest of his life. He realized that while the shops were crooked and the game was rigged, the tape itself told the truth if you were fast enough to read it.
He has that famous line, doesn't he? There's nothing new on Wall Street.
Whatever happens in the stock market today has happened before and will happen again. That was his mantra.
So even though we have AI and high-frequency trading now, the game is fundamentally the same.
Because the game isn't about numbers. It's about people. It's about fear, greed, hope, ignorance. Those human emotions haven't changed in 5,000 years. He wasn't predicting stocks. He was predicting human behavior. That's why his patterns are still relevant.
That's a powerful idea. The technology changes, the specific rigs change, but the psychology is permanent.
And the other lesson is about action. In that sugar trade, if he had stopped to ask, why do I feel weird? Or what's the logical reason for this? He would have been broke. He acted first and found the reason later.
And that's a really provocative place to leave things. We live in a world where we are just obsessed with why. We want the narrative, the full explanation before we make a move.
We are drowning in information, yeah. But this story suggests that sometimes the what is more important than the why. The boy survived because he trusted his observation over his need for a logical explanation.
So, for everyone listening, is there an area in your life where you're waiting for that perfect explanation when the data is already staring you in the face? Maybe it's time to stop asking why and just read the tape. Thanks for joining us on this deep dive.
See you next time.
All right, let's get right into this. I want you to picture New York City, 1898. It's loud, it's chaotic, steam engines, horse carriages, and it is just exploding with capital. A train pulls into Grand Central, and this 21-year-old kid steps onto the platform. He's wearing a suit that's probably a little too nice for his age, and he has exactly $2,500 in his pocket.
Which, we should probably clarify, is a ton of money for a 21-year-old back then.
A serious amount.
We're talking like nearly 100 grand in cash today.
Exactly. And he isn't just carrying cash, he is carrying this massive amount of confidence. This is Jesse Livermore. He's just arrived from Boston, where he made a name for himself and a small fortune wrecking the local betting parlors.
Right. He thinks he has the stock market completely figured out.
He walks with this swagger, totally convinced he's about to conquer Wall Street.
And honestly, if you looked at his track record up to that moment, you wouldn't blame him for being so arrogant. I mean, the guy was a prodigy, a math whiz who could do complex calculations in his head.
But here is the twist, and it's really the central mystery of our deep dive today.
Yeah.
Within 6 months of stepping off that train, Jesse Livermore is flat broke.
Zero.
Worse than zero.
He loses the $2,500, he loses all the profits he made, and he actually ends up owing his broker money. Completely wiped out.
So the mission for this deep dive is to figure out how that happened. How does a guy with a winning system, a guy winning, what, 70% of his trades in Boston, lose everything just by moving to New York?
It's a fascinating case study because it's not just a story about a bad streak of luck. It's about a fundamental misunderstanding of the environment.
He thought he was playing the same game.
Exactly. He thought it was the same game, but he walked onto a totally different playing field. So we need to unpack the difference between gambling on fluctuations, which is what the bucket shops were, and speculating on value, which is what the stock exchange demanded.
And we also have to get into the psychology of it.
Yeah.
Because Livermore, to his credit, admits later that it wasn't just the mechanics that beat him. It was his own brain. Yeah. He talks about becoming a Wall Street fool.
That is a term that really sticks with you. The Wall Street fool isn't the guy who knows nothing. It's the guy who thinks he needs to trade every single day to, justify his existence.
We are going to get into all of that, but let's start back in Boston. This is where the legend of the boy trader begins. He's hitting these places called bucket shops. Explain what those actually were, because they don't really exist anymore, at least not legally.
Think of a bucket shop not as a brokerage, but as a casino, a betting parlor. When you walked into the Cosmopolitan Stock Brokerage Company in Boston and said, I want to buy 100 shares of sugar, you weren't actually buying anything.
You're just placing a bet.
You were just placing a bet with the house on the number on the board.
So it's a closed loop. If I bet the price goes up, the house takes the other side.
Precisely. No stock changes hands. It's just a wager on the ticker price. And because Livermore was so good at reading the tape, spotting these tiny short-term patterns, he was winning constantly.
And in a casino, if you win too much, what happens?
The pit boss comes over and asks you to leave.
Right.
Exactly. The bucket shops started getting squeezed. They realized this kid was a ringer, so they started cheating him. They would charge him extra fees, widen the spread, or just flat out refuse his action.
He was basically banned from the Boston minor leagues because he was too good.
Yeah, but he also mentions a technical reason for wanting to leave. He kept complaining about the lag.
Okay, what was that about?
This is crucial. In Boston, the price quotes came over a telegraph wire from New York, so there was a physical delay. Livermore was a tape reader. His whole system was based on reacting to the price right now.
Instantly.
Right. He felt that if he could just get to the source of truth, the New York Stock Exchange, where the ticker tape was fresh, he would be unstoppable.
He thought the delay was the only thing holding him back. So he packs his bags, heads to the big city, and walks into a legitimate brokerage, A.R. Fullerton & Co.
And immediately, he runs into a bit of a social problem. He looked very, very young. He had this baby face.
They called him the boy trader.
They did. And the serious brokers on the floor of this exchange, they thought he was just some lucky amateur. They tried to take advantage of him.
But Livermore didn't care what they thought. He just cared about the tape.
Yeah.
So he starts trading. He's got his $2,500. Yeah. He uses the exact same system that made him rich in Boston. And it just falls apart.
Completely.
So let's get technical here.
Yeah.
Why? What was the mechanical difference between betting in a shop and buying on the exchange?
Okay, this is the technical core of the whole story. If you're a trader today, you need to understand this. Livermore's system failed because it relied on three things that existed in the bucket shop that did not exist on the exchange.
And those were?
Instant execution, fixed prices, and zero market impact.
Okay, let's break those down one by one. Start with instant execution.
In the bucket shop, it was like a video game. If the board said the price was a 105 and you put your money down.
You got in at 105 instantly.
Right. The house honored the price on the board.
Okay, but on the New York Stock Exchange?
The exchange is a physical place with human beings running around. When Livermore saw 105 on the ticker tape in his office, that was technically history.
It had already happened.
By the time he wrote out an order, handed it to a clerk, the clerk telephoned the floor broker shouted the order, the price had changed.
So he sees 105, he orders at 105, but he actually buys at what?
Maybe 106, maybe 107. The price has moved away from him. That is called latency, the time gap between seeing the price and executing the trade.
And in the bucket shop, that latency was 0.
0. On the exchange in 1898, it was huge.
And that leads directly to the second point, right? Slippage.
Right. Slippage is the difference between the price you expected and the price you got. Livermore's system was built on capturing small moves, maybe 2 or 3 points.
So if you're trying to make a 2-point profit, but you let 1 point to slippage on the way in and another on the way out,
your profit margin is 0. You're just running on a treadmill, paying commissions. But the third factor, market impact, is the one that really blindsided him. And this is something retail traders often forget.
in a bucket shop, you're invisible.
You're invisible. You're betting against the house. If you bet big, it doesn't change the actual stock price. It's a side bet. The real stock market doesn't know you exist.
But on the New York Stock Exchange,
You are a participant. You are supply and demand. Livermore was a big trader. He traded large volume. When he dumped 1,000 shares of a stock onto the floor to sell it, he was literally adding to the supply.
so his own trade was pushing the price down against him.
Yes, he was crashing the price with his own order. In the bucket shop, he could sell at the top. On the exchange, the moment he started selling, the price collapsed because he was selling. He was ruining his own execution just by participating.
That is a massive paradigm shift.
Imponderability is the word he uses.
Yeah.
He couldn't calculate the effect of his own weight on the market. He was trying to use a sniper rifle in a muddy rugby match.
So mechanically, he was doomed. But Livermore is brutally honest in this chapter. He doesn't just blame the mechanics. He says, I lost because I was a fool.
And this is where we get to the Wall Street fool. It's such a brilliant distinction. He says there's the plain fool, the person who knows nothing and gambles blindly.
That's the guy who buys a stock because his taxi driver gave him a tip.
Right. We all know that guy. Sometimes we are that guy. But the Wall Street fool is dangerous because he's smart. He studies the market. He knows the math.
What's his flaw?
His flaw is that he thinks he must trade all the time.
He treats it like a 9-to-5 job.
Exactly. Livermore describes this addiction to the ticker tape. He felt hypnotized by it. He had this subconscious belief that I am a professional trader, therefore I must trade every day to earn my wages.
Which sounds logical in any other profession. A carpenter has to hammer nails to get paid.
But the market is not a profession of labor. It is a profession of judgment. The market does not care how hard you work. It only pays you for being right. And Livermore explains that there are simply not enough high-probability opportunities to buy or sell every single day.
So you're trading every day, you're just forcing it.
You are hallucinating patterns that aren't there just to satisfy your need for action. The mature Livermore, the one writing the book 15 years later, is a totally different person. He talks about waiting weeks, sometimes months, doing nothing, just watching.
But at 21,
At 21, he was an action junkie. He was scalping for fractions of a point, getting chewed up by commissions and slippage because he needed that dopamine hit of being in the market.
so you combine the bad mechanics with the overtrading psychology, and you get a disaster. 6 months in, he's broke. He owes A.R. Fullerton money. Humiliated.
Most people would quit. They'd go home, get a regular job, and tell stories about how Wall Street is rigged.
But not Livermore. This is where we see the hustle. He has this line, I never argue with the tape. He doesn't get angry. He gets practical. He realizes, okay, I can't beat the exchange yet, but I know I can beat the bucket shops.
He decides to go back to the minor leagues to rebuild his bankroll. But he can't do it in New York. All their shops know his face.
So he needs a stake.
He needs a stake. He goes to his boss, Old Man Fullerton, and borrows $500. And I love that he doesn't borrow it to trade there. He borrows it to leave. It's a business loan, basically. He heads to St. Louis. He hears the bucket shops out west are less sophisticated. It's the Wild West. And this part of the story plays out like a heist movie.
He arrives in St. Louis, but he knows he can't walk in as the boy trader.
Okay.
So he creates an alias.
Forrest Kent.
Forrest Kent. And he puts on this incredible acting performance.
Mm-hmm.
He walks into the J.G. Dolan Company, one of the biggest shops there. He walks in looking nervous.
Playing the rube.
Totally. He goes up to the clerk and asks, excuse me, how much stock can I buy for $100?
The perfect sucker. He wants them to think he's just some naive kid gambling his inheritance.
And it works. They take his money. And because it's a bucket shop instant execution, no slippage, his old system just turns back on.
And he starts hammering them.
Yeah.
He trades furiously. In 2 days, just 48 hours, he turns that $500 into $2,800.
That is nearly a 500% return in 2 days.
Which is exactly why the party had to end. The earner, J.G. Dolan, calls him into his private office. And this conversation is so revealing. Dolan isn't mad.
No, there's this weird respect there.
Dolan looks at him and says, "Look, son, you made more in 2 days than I made off 300 customers in 2 weeks." He calls him a rinner. He basically says, "You aren't a customer, you're a predator. You're bad for my business model."
The business model being, taking money from losers.
Right. So Dolan pays him his winnings. He doesn't steal the money, but he tells him, "Take your money and get out. You're banned."
So Horace Kent takes his cash and walks down the street to the next shop, H.S. Teller & Co.
But news travels fast. He walks in, pulls out his cash, and the clerk literally shoves him away. He says, "We don't want any business from you or your boss, Dolan." They thought he was working for the other shop.
Wow. Blacklisted.
Blacklisted. So he takes his $2,800, goes back to New York, pays off Fullerton, and tries the exchange again. But he's still struggling. The big game is still too hard for him.
And then he gets a tip.
He hears that his nemesis, H.S. Teller, the guy who banned him in St. Louis, has opened a branch in Hoboken, New Jersey, just across the river.
This sets up the revenge in Hoboken sequence. And this is where Livermore shows he isn't just a tape reader, he's a strategist. He sets a trap.
He waits for Friday. The market had been very bullish all week. Prices were climbing. Everyone was optimistic. But Livermore was looking at the banking data. He knew that on Saturday mornings, the weekly bank statement was released.
Why does that matter?
The bank statement showed the reserves, how much cash the banks were holding. If reserves were down, it meant money was tight. Livermore calculated that the reserves would show a massive decrease.
Which is bad news for the stock market.
Terrible news. He knew the big professional traders on the NYSE floor would use that news to hammer the market down. So he takes the ferry to Hoboken on Saturday morning.
Walks into the shop. Does the manager recognize him?
No. The manager sees this young guy with a fat roll of cash and thinks, "Great, fresh meat." He actually tries to distract him, talking about horses, thinks he's just a gambler.
And Livermore just plays it cool. He waits, watches the clock. 11:15 a.m. approaches.
And right before the news drops, he strikes. He places massive sell orders. He shorts the market heavily.
And was he right?
Dead on. The bank statement hits, reserves are down, panic on the floor. The ticker tape in Hoboken starts spitting out plummeting prices. Livermore is just standing there watching the manager's face turn pale.
He cleaned them out.
He made $5,100 in a few minutes. Life-changing money. The shop didn't even have enough cash in the safe to pay him.
The manager writes him a partial check and says, "Come back Monday for the rest." That sounds suspicious.
Livermore thought so, too. He shows up Monday morning, ready for a fight. And who is waiting for him? A large man leaning in the corner. Livermore recognizes him immediately.
It's the St. Louis man.
The enforcer from Teller's original shop. The game was up. But again, there's that weird code of honor. They pay him the rest of the money. But the St. Louis man tells him, "You can never trade here again, Horace Kent. We know who you are."
But Livermore, being the relentless operator he is, isn't satisfied. He wants one last kick at the can.
He sends in a proxy, a guy named McDevitt. It's the classic straw man. McDevitt goes in, trades small lots, loses a little, wins a little, looks like a mediocre trader.
Just part of the scenery.
Exactly. While Livermore is somewhere else, analyzing the data, when he sees another perfect setup, he signals McDevitt. McDevitt plunges, they extract another $2,800, and finally, the shop just shuts down.
It's an incredible story of persistence. He basically used the bucket shops as his personal ATM. But I want to pivot to the so what here. Because at the end of this, Livermore says something surprising. He calls it the bucket shop paradox.
This is the most profound insight in the chapter. He almost speaks fondly of the bucket shops, despite them being rigged against him.
Why?
He realized that being forced out of the bucket shops was the only thing that saved him. See, bucket shops were safe in a very specific way. They had an automatic stop loss. If you put up a 1-point margin and the stock dropped 1 point...
You were out. Wiped out instantly.
Right. You lost your bet, but you couldn't lose more than your bet. You couldn't go into debt. It prevented catastrophe.
But that safety created a hard ceiling on his growth.
Exactly. It taught him to play for small fluctuations. He was always looking for a 1-point move or a 2-point move. It made him a scalper.
And you can't get truly rich scalping.
You can make a living, but you can't make a fortune. The big money isn't in fluctuations. It's in the long pull, the major trend that lasts months or years. But you can't capture a major trend if you're getting wiped out on every tiny 1-point dip.
So the bucket shop mechanics actually trained him to be short-sighted.
Precisely. If the bucket shops hadn't banned him, he would have remained a gambler. A very talented gambler, sure.
Yeah.
But just a gambler. Being forced onto the exchange where the mechanics were harder, where he could lose more than he bet. It forced him to evolve.
He had to stop betting on the number and start understanding the value of the asset. He had to learn patience.
He went from a system that exploited a glitch in a simulation to a system that worked in reality. And that transition cost him everything he had, multiple times.
It's a harsh tuition fee.
The tuition of Wall Street is always paid in losses. Livermore says a man has to lose everything at least once to really understand what not to do.
So let's bring this home to the listener. We aren't in 1898. We don't have bucket shops. We have apps on our phones. We have zero commission trading, instant data. Does any of this apply?
It applies more than ever. In fact, I would argue that modern trading apps have gamified the market to feel exactly like a bucket shop.
How so?
Think about it. Confetti explodes when you make a trade. You get push notifications if a stock moves 2%. The interface is designed to make execution feel instant and frictionless.
It's designed to turn us all into Wall Street fools.
Yes. It triggers that need to earn wages. We feel the urge to react. Apple is down 1%. I need to do something. Nvidia is up. I'm missing out. If you are reacting to those daily flickers, you are playing the bucket shop game.
You are Horace Kent in St. Louis.
Picking up pennies in front of a steamroller. The real wealth is built by the older Livermore, the guy who sits on his hands. I want you, the listener, to really ask yourself this. When was the last time you did nothing with your portfolio for a month? Can you sit still?
Because his big lesson is that the market does not pay you for your activity. It pays you for being right.
The desire for constant action, irrespective of underlying conditions, is responsible for many losses. That's the quote.
It's the difference between activity and productivity. In investing, they are usually opposites. I want to leave you with a final thought to chew on. Livermore said, "I never argue with the tape." When his winning system failed in New York, he didn't scream that the exchange was rigged. He didn't write an angry blog post blaming the hedge funds.
Even though, in a way, the mechanics were working against him, he had a legitimate grievance.
Right. But he accepted that if he was losing, it was because of his own ignorance. He blamed himself. Total ownership.
That is a brutal level of accountability, but it's the only way to improve.
So in your own life, whether it's finance, career, whatever, when a strategy that used to work suddenly stops working, do you double down and blame the world? Or do you stop and ask, has the game changed and am I just playing by the old rules?
Most people would rather lose money than admit they don't know the new rules.
Don't be the plain fool. And definitely don't be the Wall Street fool. Thanks for diving in with us.
See you next time.
I want you to picture a duel. Not, a metaphorical one, but a real old school pistols at dawn kind of situation.
Okay.
You think you're a great marksman. So you tell your second, look, see that wine glass over there? I can snap the stem at 20 paces. You raise your pistol, you fire and snap.
Perfect shot.
Perfect. The glass shatters. You are, without a doubt, very skilled. But then your second turns to you and he asks a question that just changes everything.
And it's the question that really haunts this entire deep dive we're doing today. He asks, that's all very well, but can you snap the stem of that wine glass while the wine glass is pointing a loaded pistol straight at your heart?
That imagery is just, it's visceral, isn't it?
Yeah.
It shifts the whole conversation from theoretical ability to, well, performance under existential threat.
Exactly.
That is the hook for today. We are unpacking The Education of a Speculator, a series of excerpts that chronicle the brutal evolution of a trader in the early 1900s.
We're going from the smoky backroom betting parlors, the so-called bucket shops, to the absolute chaos of the New York Stock Exchange floor.
And it isn't just about stocks. This is a case study in the difference between being smart and being, market-wise.
It really is. We are looking at a narrator who is, by all accounts, a mathematical genius. He has a photographic memory for numbers, and yet when he finally gets to the big leagues, he gets absolutely crushed.
Because, as he finds out the hard way, snapping the stem of that wine glass is a whole lot harder when the market is holding a gun to your head.
Precisely. So the mission today is to figure out why his raw intelligence just wasn't enough. We're going to trace how he lost everything, clawed his way back, made a fortune, and then lost it all again in a single afternoon.
All to learn one very specific, very mechanical lesson about how the machine actually works.
Exactly.
So let's get into his philosophy. He starts by just tearing apart some of the most common cliches in finance. We all know the terms bull and bear.
Oh yeah, people wear them like team jerseys.
They really do. But our narrator, he has zero patience for that kind of tribalism.
It's one of his first big realizations. He sees that being a bull or a bear is a trap. It's a form of rigidity. It biases your thinking.
So if you're a bull, you're always looking for reasons to buy, even when the ship is obviously sinking.
Right. His maxim is so simple, but it's profound. There is no bull side or bear side. There's only the right side.
Which sounds obvious, but, I mean, it's incredibly hard to actually practice. It means you have to be willing to flip your entire view on a dime if the facts change.
And that goes right into his view on tips.
Oh, his rant about tips is fantastic. He absolutely destroys the idea of following someone else's advice. He uses this hypothetical guy named Smith.
The Smith example is maybe the best argument against hot tips I've ever come across.
It's brutal. He says, okay, you buy a stock because Smith told you to. Great, you're in, you're making money. But now you have a huge problem.
A structural problem.
Yes.
Yeah.
You didn't buy it based on your own logic, so you have no idea when you're supposed to sell. You are completely dependent on Smith.
And that dependency is just lethal. Because what happens if Smith goes on holiday when the market turns?
Or he's out playing golf while the ticker tape is crashing.
You're paralyzed. You can't sell because you're waiting for the signal, but the signal just isn't coming.
And by the time Smith gets back from the golf course, you're wiped out. His takeaway is that a man has to believe in himself and his own judgment if he's going to make a living at this game.
You can't outsource your own survival, which connects directly to how he starts to view his own losses. And believe me, he loses a lot.
He does. But he calls it tuition. He has this wonderful line. He says, ignorance at 22 isn't a structural defect.
I love that. It makes me feel a lot better about my own 20s.
Me too. But he's dead serious. He keeps this mental list of don'ts. Every single time he goes broke, he figures out why, and he adds another rule to his list.
As long as the loss isn't total, as long as he isn't dead, he just figures he's paid a very high price for an education.
So let's get to his first big tuition payment. He's 22. He's been crushing the bucket shops in his hometown. He's got about $2,500 in his pocket.
Solid stake for back then.
A huge stake. And he arrives in New York, walks into a reputable firm, Harding Brothers, and he is ready to conquer Wall Street.
He thinks it's the same game. He sees the ticker. He sees the prices. It looks just like a bucket shop, only a bit fancier.
Right. And for anyone listening who might not know what a bucket shop was, this distinction is everything. In a bucket shop, you're not actually buying stock, are you?
No, and that is the absolute key. It's basically a gambling parlor. You're betting on the number on the board. If the ticker says steel is at 100, you bet $10 it'll go to 101.
And if it does, the shop just pays you out of their own pocket.
Exactly. There's no stock changing hands. It's you versus the house. And crucially, the execution is instant. You see 100, you get 100.
So he walks into Harding Brothers, a real exchange, and thinks he's getting that same instant deal. He starts trading like a maniac. He's scalping, just jumping in and out for tiny profits.
In 2 hours, he trades 1,100 shares.
An absurd volume. He's treating the New York Stock Exchange like a slot machine.
And the craziest part is, his picks are mostly right. He's buying stocks that go up.
But at the end of the day, he checks his account, expecting this huge profit. Instead, he's lost $1,100. Half his stake. Gone. In one afternoon.
This is the moment that reality just smacks him in the face. In the bucket shop, the price is static. In the real market, it's fluid. When he orders a buy at, say, 84, that order has to go to a clerk, then a floor trader.
Who has to find a seller in the pit.
Right. And by the time that trade actually happens, the price might be 84 and a half.
So then when he tries to sell at 85 to grab his profit.
The same thing happens, but in reverse. He sells, but by the time it executes, the price has dipped back to 84 and a quarter. He's being eaten alive by slippage.
The friction of the machine is just erasing his entire edge.
And he doesn't get it. He thinks the machine isn't as it ought to be. He literally blames the telegraph. He thinks the ticker is broken.
Not his method. The machine must be wrong.
The machine was fine. He just didn't understand how liquidity works in the real world. In a bucket shop, the shop has to take your bet. In the market, if you want to sell, someone has to want to buy.
What's so painful is that it takes him a while to figure this out. He keeps trying. He loses the whole $2,500. He's busted.
And this starts what the text calls the lean years. It's a devastating period. He has to borrow $500 just to survive.
He has to go back to the minor leagues. He leaves New York, goes to St. Louis, and starts hitting the bucket shops again with that borrowed money.
And he crushes them. That's the great irony. His method works perfectly there. He's like a pro athlete playing against middle schoolers. He makes so much money they actually start banning him.
They call him the boy plunger. and just refuses business.
But notice the trap he's in. He's winning, he's building his bankroll back up, but he still hasn't solved the puzzle of the major leagues. He just assumes New York was bad luck.
He hasn't changed his strategy at all. He's just reloading his gun.
Exactly. So he goes back to New York, he trades, he loses, he goes broke again. This happens multiple times. It's this cycle of accumulation and destruction.
Until the great boom of 1901. This is the environment that finally teaches him the lesson he needs.
But the tuition is going to be astronomical.
So let's set this scene. 1901. The narrator describes it as a time of just pure mania. The steel crowd has taken over New York. These brand new millionaires.
He calls them drunken sailors. You have to imagine it. No income tax, almost no regulation, men lighting cigars with $100 bills. A busy day on the exchange used to be 250,000 shares.
And suddenly they're hitting 3 million shares a day. The physical ticker tape, the paper ribbon with the prices, it literally couldn't keep up.
And the sentiment was just, buy!
People were buying AOT, any old thing. It didn't matter what the company did. If it had a picker symbol, you bought it.
But our narrator, he's skeptical now. He's been burned. He thinks the market is way overheated. He's bearish on most things. But then he spots something weird.
Northern Pacific. Lipper.
Right. While everything else is going wild, Northern Pacific is just strong. It's being bought aggressively. His tape reading skills tell him someone is quietly absorbing all the supply.
So going against his own bearish feelings, he switches sides. He buys 1,000 shares of Northern Pacific.
A massive bet for him. His friends tell him he's nuts. They say the whole market is about to crash. But he holds on.
He trusts the tape, and the stock just rockets up. He sells at 110.
And banks a $50,000 profit.
In 1901 dollars. That's a life-changing fortune. He's finally done it. He's conquered the machine.
He feels invincible. He's got the cash. He's got the confidence. And then comes May 9th, 1901.
The day of the crash.
We have to explain why Northern Pacific was acting so strange. This wasn't just random buying. This was the corner.
One of the most famous events in financial history. You had two titans, E.H. Harriman and J.P. Morgan, fighting for control of the Northern Pacific Railroad.
They weren't buying the stock to make a profit. They were buying it to own the company. They were literally trying to buy every single share in existence.
And while they're buying everything, you have all these other traders, short sellers, who think the price is too high. So they're betting against it.
And that is the trap. To short a stock, you borrow it and sell it, promising to buy it back later. But Harriman and Morgan had bought all the shares. There was nothing left to buy back.
The short sellers were trapped. They had to pay any price to cover their positions. It's a short squeeze.
And Northern Pacific skyrockets to $1,000 a share. But because everyone is losing so much money on Northern Pacific, they have to sell everything else they own just to stay afloat.
They dumped steel, they dumped copper, they dumped everything to cover their Northern Pacific losses.
And the rest of the market just crashes violently.
And here's our narrator, sitting on $50,000 in cash, no position. He sees this panic unfolding, he sees the market boiling, and he thinks, this is it. I can make an absolute killing.
His analysis is perfect. He sees the market is going to tank, so he decides to short the market. He bets on the crash. He is, as he says, dead right.
He starts firing off sell orders. He's looking at the ticker tape. Let's say he sees U.S. Steel at 100. He screams, sell!
Expecting to get filled around 100, maybe 99. But this is where the ghost gambler meets reality. We mentioned the volume, right? 3 million shares. The Telegraph in 1901 couldn't print that fast.
So the tape was lagging.
Lagging badly by 20 minutes, 30 minutes, sometimes an hour behind the actual trading on the floor.
Wait, so when he sees 100 on the tape, that's not the real price?
That was the price half an hour ago. In a panic like that, prices can drop 20 points in 10 minutes. So he sees 100, he orders a sell, but on the floor of the exchange, the actual price is already 80.
Oh my God. So he thinks he's selling high.
But he's actually selling at the absolute bottom of the crash. His broker executes at the market price, which is 80. Then, 5 minutes later, the tape finally prints 80, and he realizes his mistake.
Wait, the market's already down. I should be buying for the rebound.
Exactly. So he tries to fix it. He switches sides and starts screaming buy to cover his shorts.
And then lag gets him again.
Kills him again. By the time his buy order hits the pit, the snapback rally has already started. The price on the floor is back up to 95. He sold at the bottom and bought at the top.
He got completely whipsawed.
In a couple of hours, he lost the entire $50,000, not just the profit, everything. He was wiped out.
That is just sickening. I can feel that in my stomach. He was right. He predicted the crash perfectly.
He says it himself. I was dead right and I lost every cent I had. And this is really the core lesson of the whole story. He wasn't beaten because he was stupid or because his analysis was wrong.
He was beaten because he ignored the mechanics of execution. He was reading the tape as if it was reality, but the tape was history.
It brings us right back to that wine glass. He was aiming at the right target, the crash. He fired a perfect shot, but the pistol, the market mechanism, it just blew up in his hand.
And that's the difference between a theorist and a speculator. A theorist says, I knew it would go down.
A speculator has to ask, okay, but did you make money when it went down? If the answer is no, your theory is worthless.
This seems to be the moment that turns him from a gambler into a real professional. He finally stops blaming the machine.
He realizes that trying to scalp these little moves in a panic is suicide. He calls it using a shotgun and BB shot against big game. You can't hunt elephants with a BB gun.
He has to stop reacting to the tape and start anticipating the move.
Anticipation versus reaction, that's the whole shift. If you wait for the ticker to tell you what's happening in a crisis, you're already the victim. You have to be positioned before the tape moves.
The resilience is amazing, though. I mean, most people losing a fortune like that, 50 grand in 1901, is like losing millions today. They would just quit.
He admits he was sick of the game. He felt destroyed. But he didn't quit because he finally understood why he lost. Before, he was just confused. Now, he sees the mechanism clearly.
He's financially broke, but intellectually, he's never been richer.
The game taught him the game, as he says, and that game charges very high tuition. But if you actually learn the lesson, you own it forever.
So to bring this back around, most of us aren't trading stocks on a delayed telegraph in 1901. But this principle, this intelligence versus execution idea, it feels universal.
It absolutely is. I mean, think about product launches or corporate strategy. You can have the right idea. You know exactly what the market needs.
But if your supply chain, your execution mechanism is lagging, or you can't deliver when demand spikes, you lose. You lose to a competitor with maybe a worse product but better execution.
Or in leadership. You can have the perfect vision, but if you don't account for the friction in your organization, the politics, the resistance, the time it takes to get people on board, your vision is going to fail.
Being dead right in the abstract is the easy part.
The hard part is accounting for the lag, the slippage, and the panic of the real world. You have to trade the market you have, not the one you wish you had.
Well, that is a heavy lesson, but a necessary one. We've gone from snapped wine glasses to broken fortunes.
And hopefully to a little bit of wisdom.
Before we sign off, I just want to leave you with a question to think about this week. We've talked a lot about the danger of reading the tape, of reacting to old information.
It's the trap of always fighting the last war.
So ask yourself this. In your own career or your life, where are you looking at the tape instead of the reality? Where are you making decisions based on data that's already 20 minutes or maybe 20 days old? Thinking you're being smart when really you're just about to get filled at the bottom.
Are you anticipating the big move, or are you just staring at a lagging indicator? It's the difference between being a ghost gambler and a real one.
Thanks for diving deep with us. We'll see you next time.
You know, there's a specific kind of nightmare that I think anyone who works in finance, or honestly, anyone who's ambitious, has had at least once. You're back in your hometown, you're broke, you had it all right, the penthouse in New York, the reputation, the lines of credit, and you just torched it.
Yeah.
And now you're walking past the places you used to think you were too good for, and you realize, I have to start over from absolute zero.
It's the classic return to the Shire moment, but without the happy ending. It's gritty, it's humiliated.
That is exactly where we find our protagonist in today's deep dive. We're looking at the reminiscences of one of the most famous stock operators of the early 20th century.
And we're picking up his story at his absolute nadir.
He's lost 3 fortunes. He returns to the East Coast, tail between his legs, with just one mission.
Get a stake.
Get a stake, get capital, get back to Wall Street.
And the sources we're covering today, they aren't just about trading. I think that's a common misconception. It's a survival thriller.
It's a heist story.
It really is. Because the only way he can get that stake is by outsmarting a system that was, well, explicitly designed to rob him.
Right. We are talking about the era of the bucket shop, and I think we need to set the scene here, because this isn't Robin Hood. This isn't just clicking a button on your phone.
Oh, far from it. Imagine a smoky room, sawdust on the floor, a ticking telegraph in the corner.
And a guy with a piece of chalk writing numbers on a giant slate board.
That was the bucket shop. And the most important thing to understand, and the source material really hammers this home, is that a bucket shop is not a brokerage.
It's a bookie.
It is 100% a bookie. When you bought a stock in a bucket shop, you weren't buying a share of Union Pacific.
Right.
You were betting the shop owner $10 that the price on the chalkboard would go up before it went down. No stock ever changed hands. It was a wager against the house.
Which means structurally, the shop owner is your adversary.
Completely.
If you win, he loses cash directly from his pocket. It's a zero-sum game between you and the shop.
Exactly. And that dynamic sets up the entire conflict for this story. Our narrator, let's call him the boy plunger. That's what the press called him.
Yeah.
He walks into these shops with a few $100 to his name. And he has a problem.
He's too good.
He's lethal. He has this photographic memory for the tape, the flow of prices. He can spot the patterns.
So he walks into a shop, places a few trades, and just quickly pulls out a few $100s of profit.
And the shop owner isn't stupid.
No.
No. The source describes this great moment where he tries to place another trade, and the owner just looks at him and says, "We don't want your business here."
He's blacklisted.
Just like that. It's like counting cards in Vegas. Once the pit boss spots you, you're done.
So he's effectively banned from the easy money, but he finds these new shops, right? The ones run by strangers who don't know his face yet.
Right, but they have a different defense mechanism.
The gentleman's limit.
It sounds so polite, doesn't it? The gentleman's limit.
It sounds like a dress code.
It was actually a mathematical chokehold. These shops limited your trades to like 15 or 20 shares.
Okay.
Now, to the average guy betting his lunch money, that's fine. But for a professional speculator trying to build a fortune, it's a death sentence.
Let's dig into that math for a second, because I think this is where people can miss the point. Why does a 20-share limit matter if he's still winning? He's still making profit, right?
He's making arithmetic profit, but he needs geometric profit.
Okay, explain that.
If you start with $500 and you want to get to $50,000, you have to compound. You bet small, you win, your bankroll grows, so your next bet is bigger, you size up.
That's the only way to get rich quickly.
It's the only way. Ah, I see. If the shop caps your bet size, they're capping your velocity.
Precisely. If he's capped at 20 shares, his growth curve is flat. It would take him 10 years to make enough money to get back to New York.
And he didn't have 10 years. He needed to get back now.
So he resorts to subterfuge. He tries a proxy scheme. And reading this part of the source material, it felt like watching a spy movie.
It really does. He recruits a friend. The plan is simple. The narrator stands by the ticker, looking bored, maybe chewing on a toothpick. He gives a subtle signal. Maybe he touches his chin or checks his watch. And the friend, who's over the counter, places the maximum bet.
And they're splitting the profits.
Right. And it works for a little while. But these bucket shop managers, they're paranoid.
Yeah.
They spend all day watching the room for sharps.
They're looking for the tell.
And they found it. There was an assistant manager, a guy named Joe. He's been watching this friend place all these winning trades.
Okay.
And he notices a correlation. The friend never trades unless the narrator is in the room.
That's a rookie mistake. You have to separate the variables.
Of course.
If you're going to run a proxy, the principal shouldn't be standing 5 feet away.
It's a mistake born of desperation. He wanted to see the tape himself. So one day, the friend tries to sell some stock. I think it was St. Paul. And Joe just stops him.
Right in the middle of the room.
Loud enough for everyone to hear. He says, "It's damn funny you never trade unless Livingston is around."
Livingston being the alias our narrator is using.
Right. And just like that, the gig is up. The proxy scheme is dead.
So let's pause and look at the scoreboard. He's banned from the big shops. The small shops have capped his betting size so he can't make real money.
And his proxy scheme is blown.
He is completely shut out of the board money.
He is stuck in financial purgatory. He has enough money to survive, maybe buy a nice dinner, but nowhere near enough to get back to the real stock exchange in New York.
And this is where the story shifts.
Yeah.
Because when you're desperate, you become vulnerable.
Enter the wolf.
Enter the wolf in sheep's clothing, or in this case, a very expensive suit. This is the character Roberts.
Yes. The narrator's in a hotel lobby, probably looking frustrated, complaining to someone about rotten execution, basically that the bucket shops are cheating him on the price.
And Roberts just slides in.
The classic, "I couldn't help but overhear" maneuver. Roberts is smooth. He tells the narrator, "Look, you're wasting your time with these local joints. You need to trade with a real wirehouse."
And we need to distinguish a wirehouse from a bucket shop here, because Roberts makes them sound so legitimate.
Oh yeah, he uses all the buzzwords. Confidential connections, direct lines to the cotton exchange, special attention.
He's selling prestige. He's saying, we aren't a gambling parlor. We are a brokerage for sophisticated gentlemen.
But then he drops the hook.
Yeah.
He offers rebated commissions.
And that is the red flag.
It's a massive red flag. The narrator knows this immediately. Legitimate exchanges, the NYSE, the Cotton Exchange, they operated like a cartel.
Right. They had strict, fixed rules on commissions.
Exactly. If you were catching a rebate or paying less than the standard rate, you were breaking the bylaws.
So the fact that Roberts is offering a deal on the fees proves that he isn't actually sending the trades to the real exchange.
Exactly. If he were a real broker, he'd get expelled for offering a rebate. So the narrator knows, right there in the hotel lobby, that Roberts is a crook. These aren't real brokers.
They're just bucketeers with better furniture.
That's all they are.
But, and this is the part I love, he goes to see them anyway. Why?
Curiosity. Desperation? Probably a mix of both. But the source material gives us this incredible, really dark look inside how these fake wirehouses actually operated.
It was industrial-scale fraud.
It was. The tip sheet scam was one that stood out to me. It's so simple, but so effective.
Explain that one.
Oh, it's brilliant in its evilness. The firm sends out telegrams to, say, 1,000 people. To 500 of them, they say, buy Union Pacific.
And to the other 500?
They say, sell Union Pacific.
So no matter what the stock does, 500 people think the firm is a genius.
Exactly. Then for the next trade, they take those 500 winners and split them again. 250 buy, 250 sell.
Wow.
After 3 or 4 rounds, you have a small group of people who believe you're a prophet who cannot miss.
Yeah.
And then
you ask them for their life savings.
you got it. It is survivor bias, weaponized.
But the thing that really made my skin crawl was the discretionary pool.
That is the nastiest trick in the book.
Yeah.
Roberts and his firm would convince people, usually people who didn't understand finance, like teachers or the elderly, to sign over control of their accounts.
Trust us, we're the experts.
Don't worry your pretty little head about the charts. We'll trade for you. And the firm's philosophy is explicitly quoted in the text. One of the partners says, customers are bound to lose their money anyway.
I might as well take as much of it as I can. That is cold.
It's predatory. They would just churn the account buy and sell constantly until the commission fees ate up every single dollar. Or they'd just fake a loss and pocket the principal.
So here's the million-dollar question. The narrator knows all of this. He sees the red flags. He knows these guys are sharks. Why does he sign up with them? Why walk into the trap?
This is the pivotal character moment. It shows his arrogance, but also his genius. He doesn't care about the ethics. He cares about leverage.
Leverage.
These crooked firms wanted to lure people in, right? So they offered very loose margin rules. You could control a massive amount of stock with a very small down payment.
Yeah.
The narrator did the math. He figured, I know they want to steal from me eventually, but if I'm fast enough, if I'm smart enough, I can use their leverage to make a killing and get out before they close the trap.
He thinks he can eat the bait and spit out the hook.
Exactly. He's dancing with the devil because he needs the dance floor.
So he sets up this operation, and operation is the right word. He doesn't just open one account.
No. He goes tactical.
Right.
He opens accounts at 5 different crooked wirehouses. But then, and this is key, he also has an account at a legitimate stock exchange broker. A real one.
And he rents a private office.
Yes. He gets a private office with direct telegraph wires. He needs to be faster than the bucket shops. He's building a spider web.
Okay, let's unpack the hack. The source calls it the inactive stock trick. This is the climax of the heist. I want to really understand the mechanics here.
It's market manipulation, pure and simple, but used against the manipulators themselves. Step 1. He scans the market for a specific type of prey. He needs a stock that is dull, inactive.
Meaning nobody's trading it?
Right, low volume. Maybe it hasn't traded in a few hours. The order book is thin.
Can you explain thin order book for a second?
Sure. In a liquid stock like U.S. Steel, there are thousands of buyers and sellers at every price point. If you sell 100 shares, the price barely moves.
Right.
But in inactive stock, there might only be one guy willing to buy at $100, and the next guy is only willing to buy at $90.
Okay, so the ice is thin. If you step on it hard enough, it breaks.
Exactly. That is the vulnerability. Step 2. He sends orders to all 5 of his crooked wirehouses to BUY this inactive stock. He bets big.
But remember, the wirehouses don't actually buy anything.
Correct. They just book the bet. They're betting against him. They look at the ticker tape, see the price is 100, and they say, okay, you're on. They assume nothing's going to happen.
Because the stock is dead. Step 3.
This is the kill shot. The second those bets are placed, he calls his legitimate broker and sells 100 shares of that same stock on the real New York Stock Exchange.
And he tells his broker to sell it aggressively. Sell at the market.
Now, because the stock is inactive,
Because nobody is buying, his sell order crashes the price.
he manufactures a dip. He forces the price down from 100 to, say, 98.
So the ticker tape machines all over the country print price 98.
And the wirehouses see that print. They have to execute his buy orders at that low price. So now he owns the stock in their books at $98.
Wait, I want to make sure I get this. He forced the real price down so that the bucket shops would give him a cheap entry point.
Yes. He tricked them into giving him a bargain price that he essentially created himself.
And
Then he reverses it. He goes back to the real exchange and buys the stock back. Since the stock is illiquid, his buying pressure forces the price right back up to 100 or 101.
the wirehouses have to pay him out on the difference.
He bought at the fake low of 98 and sells at the restored price of 101. He's making $3 per share across 5 different shops. He was clearing $600 to $800 every time he did this.
That is. It's arbitrage, but it's aggressive. It's like breaking a window to buy the glass cheap, then fixing it and selling it back.
It was genius. He was milking them. He was using the liquidity of the real market to manipulate the pricing of the fake market.
But like all good things, it had to end. He got greedy.
The market got wild. One day, he tries a trick, but instead of the price dropping 2 points, it drops 10 points. The swing was massive,
Which means the bucket shops owe him a fortune.
a massive fortune. And this leads to the showdown. He walks into the main wirehouse, the one run by the manager who had courted him, the guy who promised fair play, to collect.
And I assume the manager was thrillingly happy to pay him.
Laughs. Not quite. The manager is apoplectic. He is screaming. He refuses to pay. He yells that it was a fictitious market and a rigged job.
I mean, to be fair to the crook, he is right. It was a rigged job.
It absolutely was. But the narrator turns the tables in such a beautiful way. He doesn't admit to rigging it. He just looks at the manager and plays the honor card. He says, you took my order, you let me in, now you have to let me out.
He's leveraging the one weakness these firms have.
Reputation. These firms are illegal, essentially. They can survive police raids, they just pay a bribe. They can survive lawsuits. But the one thing a gambling house cannot survive is a reputation for welshing.
If the suckers find out that the house doesn't pay when you win, the game is over.
Nobody will bet.
Exactly. It would kill their business overnight. So the manager is trapped. He knows he's been hustled. He knows it was a rig, but he has to pay to keep the scam alive for everyone else.
So he pays.
He pays.
He throws the money at him, kicks him out, and tells him never to come back.
But it doesn't matter. The narrator has his stake. He's got the cash. He buys a car, and he's ready to head back to New York.
But there's one last stop. And honestly, this is my favorite scene in the source material because it's just pure pettiness.
The New Haven episode, the Yale Boys.
Yes. He's driving to New York with a friend, and they stop in New Haven, Connecticut, home of Yale University. And naturally, they find a local bucket shop.
Can we talk about the manager of this shop? The text calls him the orator.
He is a character. He looks like a senator or a Shakespearean actor. He sees these 2 young guys in a sporty roadster, and he immediately stereotypes them.
Ah, dumb rich college students, freshmen with daddy's money.
He thinks he sees lunch walking through the door.
He gives them this incredible flowery speech. He talks about the benevolence of the ticker.
He says, and I love this quote, "The market yearns to yield pocket money to the intelligent undergraduate."
The market yearns to yield pocket money. I'm going to use that. It's such a hustle.
It's the ultimate con artist speech. He thinks he is about to fleece 2 naive kids.
So the narrator plays the role. He acts shy. He asks dumb questions.
"Oh, sir, do you think this stock might go up?"
It's the long con. He lulls the orator into a false sense of security. He loses a little bit on purpose just to bait the trap. And then, bam.
He switches gears. He starts hitting the trades hard. He uses his tape reading skills to predict the short-term moves perfectly.
And by the next morning,
He has cleaned the shop out. $1,500.
which is roughly $45,000 in today's money.
Just ripped out of the shop in 24 hours.
And the cash out scene is painful.
The source describes the manager counting out the bills. It says his fingers were sweating mucilage like glue. He physically couldn't bear to let go of the cash. He was counting it so slowly, hoping maybe the narrator would die of old age before he finished.
And then the narrator, just to twist the knife, tries to place another trade.
And the mask drops. The orator drops the Shakespearean act. He slaps the counter, waves the money away, and shouts, "Take away that bauble."
Take away that bauble.
And then he calls them the biggest sharks in the United States.
Which, coming from a guy running an illegal gambling den targeting college students, is high praise.
It is. But notice what the narrator takes away from this. The manager wasn't just mad about the money. He was furious because his pride was shattered.
Right.
He thought he was the apex predator. He thought he was the wolf eating the sheep. And he turned out to be the mutton.
So he leaves New Haven pockets full, ego boosted. He has survived the blacklist, the gentleman's limit, the wirehouse scams, and the Yale orator. He finally returns to Wall Street.
This is his third attempt at the big leagues.
And we have to remember, the first two attempts were disasters. He lost $10,000 the first time. He lost $50,000 the second time.
And that brings us to the core philosophy of this entire deep dive. Why did he have to go through all of this? Why the bucket shops? Why the scams? Why couldn't he just have been successful from day one?
The source material frames this in a really interesting way. He talks about trading out of season.
Yes. He realizes that his previous bankruptcies happened because he was impatient. He was trying to force the market to pay him every day.
He was gambling, not speculating.
Exactly. He was trying to dictate terms to the market instead of waiting for the market to present an opportunity.
And the bucket shops taught him that.
They did.
Yeah.
Because the odds were so stacked against him in the shops, he had to be perfect. He had to wait for the sure thing like the inactive stock trick, or he would be wiped out.
The rigged game forced him to become disciplined.
It did. The source ends with a thought that I think applies to almost anything. Startups, creative work, relationships. He says, there is nothing like losing everything to teach you what not to do.
Losing as tuition.
That's it. We often look at failure as a stop sign. Oh, I failed. I guess I'm not good at this.
But the argument here is that you cannot truly learn how to win until you have completely, utterly understood the mechanics of losing.
You have to strip away the mistakes, the gambling, the impatience, the arrogance. Only when those are gone does the winning path reveal itself.
So the bankruptcy wasn't a failure. It was the fee he had to pay to become a master.
It was the most expensive education in the world, but for him, it was the only one that worked. He had to learn what not to do to finally see what to do.
That's a powerful place to land. It changes the way you look at your own bucket shop moments.
Absolutely. The obstacles aren't just in the way, they are the way. They're teaching you the specific skills you need for the next level.
Well, on that note, we're going to wrap up this deep dive. Whether you're trading stocks, building a business, or just dealing with a Yale orator in your own life, remember, sometimes you have to lose the hand to learn the game. Thanks for listening.
Keep learning. I want you to picture a stock trader. You know, the Hollywood style. What do you see?
Oh, chaos. Absolute chaos. People are screaming into two phones at once, veins popping out of their necks, ticker tape flying everywhere. It's all about adrenaline, right?
Exactly. We're sort of conditioned to think that high-stakes finance is all about speed, that the person who wins is, the one with the fastest reflexes, the one who spots the blip on the radar a millisecond before the other guy.
Yeah, it's that Wolf of Wall Street image. If you aren't doing something, you aren't making money.
Well, today we are going to completely dismantle that image. We've got a stack of research here, and we're specifically focusing on Chapter 5 of what is, well, the absolute Bible of trading, Reminiscences of a Stock Operator. And the main argument is going to sound incredibly counterintuitive.
It's going to sound boring, actually.
It is. The argument is that the big money, it doesn't come from the frantic activity. It doesn't come from speed. It comes from sitting.
It's just sitting, which sounds like the easiest thing in the world to do. But as we unpack this, you're going to see that sitting tight when, millions of dollars are fluctuating, it's probably the most psychologically violent thing a human being can endure.
So let's dive into this. We're going back in time a bit here, aren't we?
We are. We're in the early 20th century. Think 1910s, 1920s. There are no computer screens. It's all bucket shops, thick cigar smoke, and that ticking sound of the Brath machines spitting out paper tape.
But even though the tech is ancient, the biology hasn't changed. The human brain is exactly the same. And that's why this specific chapter is still passed around on trading desks today.
It's basically the manual on how to stop being your own worst enemy.
So the narrator, and this is basically the legendary trader Jesse Livermore, he starts off by throwing a bit of shade at a specific type of person. He calls them
tapeworms.
Tapeworms, not a flattering nickname.
Definitely not.
I assume he doesn't mean the parasite. Or maybe he does.
Metaphorically, maybe. But a tapeworm, in this context, is what we would call a screen watcher today. This is the guy who is glued to the ticker tape. He's obsessed with every single tick up and
Every single tick down.
Yeah. If the price changes by an eighth of a point, his pulse changes.
The text says these people fail because of over-specialization. Which stopped me for a second because usually, in our deep dives, we talk about how specialization is a superpower. So why is it a weakness here?
It's a weakness because they're specializing in the wrong thing. They're specializing in the math of the moment, not the reality of the market. They treat the stock market like it's a pure arithmetic equation. If A happens, B must happen immediately.
So they're looking for certainty in a game that's all about probability.
Exactly. They are rigid. The narrator tells this story about a Frenchman he met when he first came to New York, and this guy was like the grandfather of technical analysis, a chartist before charts were cool.
The guy with the curves.
The guy with the curves. He claimed his math never lied. He could take any past market crash or boom like the Atchison preferred manipulation, which was this famous cornering of a railroad stock, and he could lay his chart over it and say, see? My geometry predicted the buying point right here.
That's the classic hindsight bias, isn't it? Everything looks obvious when you already know the ending.
It is. But the narrator makes a really subtle point here. He says the Frenchman was incredibly persuasive. The math did work on paper. But when they tried to trade it in real time...
They got crushed.
Crushed.
Why? I mean, if the math explains the past, why can't it predict the future?
Because the method was too slow. By the time the curve confirmed the move was already happening. The friction of the real world, the time it takes to place an order, the slippage, it just destroyed the mathematical edge.
And then you have the randomness factor. The text mentions another guy, a brilliant mathematician, who is winning big until something happened that isn't in any equation.
World War I. The war broke out and knocked all precedents into a cocked hat. If you're just staring at a line on a graph, you don't see the Archduke getting shot in Sarajevo. The lesson here, and it's a huge one, is that charts are just a map of what happened. They aren't the territory.
The narrator has this great line. He says, not even a world war can keep the stock market from being a bull market when conditions are bullish.
And that's the shift. He stopped looking at the tape, all the tiny wiggles, and started looking at conditions. Is the country glowing? Are earnings up? If the big conditions are right, the war is just noise.
This realization seemed to change his whole lifestyle. He stops being the tapeworm. He says, the game of beating the market exclusively interested me from 10 to 3 every day, and after 3, the game of living my life.
Which is such a healthy divide.
It is. He sounds like a modern biohacker. He talks about going to bed early, eating perfectly, avoiding stress. He says, I couldn't afford anything that kept me from feeling physically and mentally fit.
Well, that's not just self-care, that's risk management. If your edge is your judgment, you can't have a foggy brain.
Okay, so he's got his health sorted. He stopped staring at the ticker every second. But he admits he still wasn't making the big money. He was doing okay, but he wasn't wealthy. And this brings us to what I think is the funniest part, the source material.
A hierarchy of suckers.
The hierarchy of suckers. It's a brutal taxonomy.
It is.
He breaks down the different levels of people who lose money. At the bottom, grade 1, you have the tyro.
The raw beginner.
Yeah. This is the person who knows absolutely nothing. They hear a tip at a cocktail party, they buy the stock, they lose their shirt. We don't really need to analyze them. We know why they lose.
Pure ignorance.
Right. But the narrator isn't interested in them. He's obsessed with grade 2.
The semi-sucker.
The semi-sucker. This is where it gets a little uncomfortable because I think a lot of intelligent people, maybe even us, fall into this category sometimes.
Oh, I definitely felt called out reading this. So define the semi-sucker for us. The semi-sucker is the sophomore of the market. They've read the books, they know the jargon, they know not to blindly buy a tip, they study earnings reports, they know the history, they feel competent.
They sound like the ideal investor.
They sound like it. In fact, the semi-sucker looks down on the tyro. He thinks, I'm not gambling, I'm analyzing. But the text says these people are the all-the-year-round support of the commission houses. They last about 3 or 4 years before they blow up.
So what's their fatal flaw? If they're doing all the work, why do they lose?
Because they are obsessed with being clever. Specifically, they're obsessed with locking in the win.
Wait, hang on. You never go broke taking a profit. That's the golden rule, isn't it? My dad told me that.
It's a very common saying, and the narrator just shreds it. He says, Neither do you grow rich taking a 4-point profit in a bull market.
Okay, walk me through this. Why is taking a profit a bad thing?
It's not that profit itself is bad. It's that the semi-sucker is playing a different game than the market is playing. Let's say you buy a stock at $100. It goes to $105. The semi-sucker thinks, I'm smart. I made $5. Stocks go up and down, right? So I'll sell now at 105, wait for it to dip back to 102, and I'll buy it back.
That sounds perfectly logical. Buy low, sell high, rinse and repeat.
Right. And it satisfies the ego. You feel like a sniper. But here's the problem. In a real bull market, what the narrator calls the big swing, the stock doesn't go back to 102. It goes to 110, then 115, then 150.
And the semi-sucker's just sitting here with cash in his hand.
He's on the sidelines with his tiny $5 profit. And here is the psychological torture of it. He cannot get back in because his ego won't let him. He's sold at 105. He can't admit he was wrong and buy back in at 112. That feels like losing. So he waits. He waits for a dip that never comes. And he watches the stock go to 200. He misses the life-changing money because he was too busy trying to be clever with the pocket change.
Wow. So he misses the forest because he was too busy chopping down one single sapling.
That's it, exactly. He thinks he's playing the market, but the market is playing him.
This brings us to the hero of the chapter. The man who finally beat this semi-sucker habit out of the narrator, a guy named Mr. Partridge.
But everyone called him Old Turkey.
Old Turkey. I love the description of this guy. He's the old sage of the office. Thick chest, chin resting on his breast, always polite. And he's known for two things. He never gives tips, and he never brags.
But he does have that catchphrase.
The catchphrase, it's almost annoying in the text. No matter what happens, if someone tells him the market is crashing or the president is sick or a company is going bankrupt, Old Turkey just smiles, tilts his head, and says,
It's a bull market.
It's a bull market.
At first, the narrator thinks the guy is just, senile, like, okay, Grandpa, thanks for the update, we know. But then we get the story of Elmer Harwood, which really drives the point home.
Right. Elmer Harwood, he's the contrast. He's the classic, semi-sucker smart, frantic, always trading. And he had previously given Old Turkey a tip to buy a stock called Climax Motors.
And Old Turkey listened. He bought it, and now he's sitting on a big profit. So Elmer comes rushing in one day, totally panicked. He says, Mr. Partridge, I just sold my Climax Motors. My sources say there's a pullback coming. It's going to drop. You should sell now and buy it back cheaper.
Hey, again, this is the smart play. Elmer's practically begging him. He's trying to save the old man some money.
Elmer has already sold his own shares. He's putting his money where his mouth is. But Old Turkey, he looks at him like he's crazy. The text says he literally starts whining. He goes, no, I can't do that.
Elmer is so confused. He's like, I gave you the tip. It went up. Just take the money.
And then Turkey delivers the line that changes the narrator's life. He says, my dear boy, if I sold that stock now, I'd lose my position. And then where would I be?
I'd lose my position.
That is the concept we need to tattoo on our brains.
Okay, let's break that down. Position. For a listener who doesn't trade stocks, it sounds like he just means owning the shares. So why is position worth more than the actual cash profit he could take right now?
To Old Turkey, position isn't just ownership. It's the strategic advantage of being aligned with the major trend. Think of it like a high-speed train leaving the station.
Okay, the train is the bull market.
Right. The train is moving. Old Turkey is on the train. Elmer is saying, hey, hop off the train at the station, run into the gift shop, grab a sandwich, and then hop back on the train at the next stop.
But the train is accelerating.
Exactly. Old Turkey knows he's an old man. He knows he isn't fast. If he hops off that train, he might slip. The doors might close. The train might speed up. If he loses his seat on that train, he is left standing on the platform while the train goes to the moon.
So he's saying, I have paid a high price for my experience. He knows that the risk of being left behind is infinitely worse than the risk of riding through some small dip.
Precisely. He says, to lose your position is something nobody can afford. Not even John D. Rockefeller.
That is a massive statement. Even the richest man in the world can't afford to be out of position in a bull market.
It's all about opportunity cost. If the market moves 500% over 2 years and you are constantly jumping in and out trying to scalp 5% here and there, you are working 10 times harder to make 10% of the money. Old Turkey's genius was realizing that his job wasn't to trade, his job was to sit.
And this leads to the quote that just sums up this entire deep dive.
It never was my thinking that made the big money for me. It always was my sitting.
My sitting tight.
It sounds so passive. Just sit there. But think about the willpower that requires.
Well, let's talk about that, because I think people hear sit tight and they think lazy. But the narrator gives an example of just how painful sitting can be. He talks about a specific trade where he was short, betting the market would go down.
Right. And he's correct. The market is crashing. He is up over $1 million in paper profits.
$1 million. And this is 1910s money. We are talking an absolute fortune.
But then the market rallies. It bounces back up. He knows intellectually that this rally is temporary. It's just a dead cat bounce. But he watches his profit drop from $1 million down to $500,000.
He watches $500,000 just evaporate into thin air.
Can you imagine the nausea?
I would be smashing the close trade button so fast I'd take the $500,000 and run.
And that's what the semi-sucker does. But the narrator stood pat. He sat tight. He let $500,000 vanish because he knew the big swing wasn't over. He knew that if he covered his short now, he would lose his position. And if he lost his position, he might not have the courage to get short again when the crash really happened.
That is just terrifying.
It's nerves of steel. But he was right. The rally faded, the crash continued, and he made far more than the original $1 million. But he only earned that because he was willing to suffer through the volatility without moving.
He talks about the cost of trying to be perfect. He mentions trying to catch the last eighth.
Yes, the last eighth. That's the absolute top or the absolute bottom price. He says those 2/8, the top and the bottom, are the most expensive things in the world.
Why?
Because trying to find them has cost traders enough millions to build a concrete highway across the continent.
That is such a great visual. A concrete highway paved with the regrets of people who tried to time the market perfectly.
It's a warning against perfectionism. You don't need to buy at the exact bottom. You don't need to sell at the exact top. You just need to catch the middle 60% of the big swing. If you catch the meat of the move, you get rich. If you try to catch the edges, you go broke.
So if we zoom out, this is really a story about a character transformation. The narrator starts as a gambler, a tapeworm, and becomes a speculator.
And we should probably clarify that word, speculator.
Yeah, usually that's a dirty word.
In this book, it's the highest praise. A gambler bets on the fluctuations. He asks, what is the price doing right now? A speculator observes the conditions. He asks, what must the price do eventually, based on reality?
So the gambler's trying to guess the coin flip. The speculator sees that the casino is tilting the table and just bets on gravity.
That is a perfect analogy. And the gap between now and eventually is where the sitting happens. That's where the pain is, but that's also where the money is.
He says, men who can both be right and sit tight are uncommon.
It is the rarest skill. Intelligence is common. Patience is rare. He says the market doesn't beat these traders. They beat themselves. They have the brains, but they just can't sit tight.
And he ties this back to that idea of living well. He says he learned to study his own psychology just as much as he studied the earnings reports.
Which makes total sense. If sitting is the hardest part, then your own impatience, your own greed, and your own fear, they're your biggest enemies.
Doing nothing is surprisingly stressful.
It is. We are wired to act. Biologically, if there's a threat, we run. If there's an opportunity, we grab. But in long-term strategy, whether it's stocks or building a business or even managing a career, acting on every impulse is fatal. Sometimes the action is just anxiety in disguise.
Action is anxiety in disguise. I like that.
That's what Elmer Harwood was. He was anxious about the pullback, so he sold. He relieved his anxiety, but he lost his fortune. Old Turkey sat with the anxiety, ignored it, and kept his fortune.
So as we wrap up this deep dive into the art of sitting tight, I think we need to apply this beyond the ticker tape.
Oh, absolutely. The principles are universal.
Where are we being semi-suckers in our own lives?
That's the question. I mean, think about your career. Are you the guy jumping jobs every 18 months for a tiny salary bump?
Locking in the small profit.
Exactly. You're taking the small win, but you're losing your position in a company where you could have ridden a massive wave of growth over 10 years.
Or in a business. Pivoting your strategy every time you have one bad month.
Right. You're reacting to the fluctuations, the wiggles, instead of trusting the conditions. If the fundamental conditions of your business are good, the dip is just noise. But if you pivot, you lose your position.
So the challenge for you, the listener, today is to identify the big swing in your own life.
Identify the big swing. Do the work to make sure you're right about the direction. And then the hardest part.
Do absolutely nothing.
Sit tight.
Thanks for listening to this deep dive. Don't lose your position.
See you on the big swing. Okay, so imagine this. You're walking down the Atlantic City boardwalk. The sun is out, salt air. You're totally relaxed. Your portfolio's empty. You're flat. The market's in, zero stress. You wander into a brokerage office, just out of habit, to check prices. You see a stock. It's climbing. Everything looks perfect. And then this absolute physical panic just hits you.
Yeah, and not just like a nervous twitch. We're talking about an overwhelming, completely irrational compulsion to bet against the strongest stock in the entire market right now.
That is the mystery we are diving into today. We are back with Jesse Livermore, the boy plunger, looking at chapters 6 and 7 of our source material. But this isn't 1929 yet. We're in the year 1906.
A pivotal year. I mean, this is really the moment Livermore goes from being a stock picker to a true market operator. And honestly, the lessons here, they aren't even really about finance.
No.
They're about the psychology of intuition and the incredibly high cost of listening to other people.
Right. And before we get to that panic on the boardwalk, we should probably set the stakes. Livermore is not the kid in the bucket shops anymore. He's graduated.
Right. And that distinction matters so much. In the bucket shops, he was basically just betting on a number. He didn't own a thing. It was just a wager.
But by 1906, he's at Harding Brothers. This is a legitimate New York Stock Exchange brokerage.
Exactly. So when he buys, he's actually buying the certificates. He's moving real assets. And that just, it changes the entire physics of the game.
So the margins are different.
Totally. In a bucket shop, if you were wrong by even a tiny bit, you were just wiped out instantly. At a real broker, the margins are bigger, the whole process is slower, and the risk, it just feels heavier. You're not just scalping a point here and there.
You have to be right about the big picture. And he's swinging 4,000 shares at a time.
For a guy in his 20s, that is serious leverage. So, okay, set the scene. It's spring 1906, Atlantic City. He's there to clear his head.
He walks into the Harding Brothers branch office. He sees Union Pacific, the darling of the market, trading strong. It's moving up. The tape looks great.
And the economy is booming. There is literally zero bad news anywhere.
And yet he turns to his friend and says, I need to sell Union Pacific.
The friend, of course, thinks he's completely nuts. He asks why. And Livermore just can't answer. He literally says, I don't know. I have to sell.
And he doesn't just sell a little. He sells 1,000 shares and another 1,000. He ends up shorting this massive position against a rising stock for no reason he can articulate.
Now, in the book, Livermore spends a lot of time analyzing this moment later in life. Because, at the time, it felt like magic or maybe a ghost telling him what to do.
But looking back, he realized it wasn't magic at all, was it?
Not at all. It was data processing.
Pure data processing.
I mean, think about it. Livermore had spent nearly every single day since he was 14 years old just watching price quotes. He had stared at the behavior of buyers and sellers for thousands and thousands of hours.
So his conscious mind sees price going up. But his subconscious mind?
His subconscious is seeing the quality of the buying. It's noticing something's off. Maybe the buying is a little too desperate, or the selling is hitting the tape in a rhythmic way that usually comes before a crash.
It's like a grandmaster chess player who looks at a board and just sees danger before they can even tell you which pawn is out of place.
Exactly. He calls it the subconscious mind, working faster than the conscious mind. It's not a hunch, it's a conclusion. It's a conclusion from a data set he couldn't put into words yet.
And that conclusion was screaming, sell!
Which brings us to the payoff. A few days later, the news hits.
The San Francisco earthquake, April 18th, 1906.
One of the biggest disasters in American history. The city is just in ruins, fires everywhere.
And here's where the market psychology gets really interesting. You'd think stocks would crash the second that news hit the wire in New York.
But they didn't. Not at first. The market held up. The public, and even the professional traders, were in this state of denial. They treated it like a local fire. Oh, that's terrible for San Francisco, but, the railroad will be fine.
But Livermore, he didn't buy that denial for a second.
He understood the macro of economics. You can't just wipe out a major American city without draining capital from the entire system. Rebuilding takes cash. That cash has to come from Wall Street. He knew the crash was coming, even if the tape hadn't reacted yet.
So while everyone else is hesitating, he doubles down. He pyramids his position, sells another 5,000 shares.
He presses his advantage. And when reality finally sinks in for everyone else, the market collapses. Livermore covers his shorts for a $250,000 profit.
$250,000 in 1906 money.
It was his biggest win ever. But the money, and this is the key, the money wasn't the lesson.
No, it was the validation.
It was the validation. The lesson was that his subconscious competence was real. He learned that when that internal alarm bell rings, you don't wait for verification, you act first, and you look for the reason later.
If he had stopped to try and explain his logic to his friend on the boardwalk, he would have totally missed the trade.
Logic takes too long. Trained instinct is immediate.
Okay, so that's Atlantic City. He trusts his gut, ignores the noise, makes a fortune. He must feel invincible. But then summer rolls around.
And we get the Saratoga story. And this is the perfect counterweight to the first one. Because if Atlantic City taught him to trust himself, Saratoga taught him what happens when you stop.
He's in Saratoga Springs, same setup, watching the board, and he sees Union Pacific again.
His old friend.
And this time, the tape is telling him to buy. He sees what he calls accumulation. Someone big is quietly buying up all the shares around $160, so Livermore starts buying too.
He's doing everything right. He's reading the tape, not the news. He's building a massive long position. He's totally in sync. But then the villain of the story enters. Well, not a villain, really. A friend.
Ed Harding, the head of the brokerage firm itself.
And we have to stress this. Harding isn't trying to scam him. He's a smart, wealthy, experienced insider. He calls Livermore, and he is just panicked.
He basically says, you're being the patsy.
Yeah. The insiders are feeding this stock to you. They're pumping it up to dump it on suckers like you. Get out.
Now, just imagine the pressure. You're young. This is your broker.
Right.
He knows the CEO, the bankers, the real players, and he's telling you that your own reading of the tape is a complete hallucination.
And Livermore folds. That's the tragedy of it.
Yeah.
He abandons his own judgment. He sells his long position.
He doesn't just go flat either. He goes short. He flips 180 degrees just because Harding was so convincing. He bets against the very stock he was just buying.
It's the worst mistake of his career up to that point. Because the very next day,
Union Pacific announces a 10% dividend.
which, for a railroad stock in 1906, is just monumental. It's like a tech company doubling its earnings overnight. The stock didn't just go up, it gapped up. It exploded.
And Livermore is short. He's on the wrong side of an explosion.
He's trapped. And this is where you see why he's a master. Most people would just freeze. They'd pray. They'd say, oh, maybe it'll come back down. Not Livermore. He sees the price, realizes Harding was dead wrong, and he covers immediately.
He takes the loss.
$40,000. Gone in a blink.
But then, and this is the part I love, he flips again. He goes right back to his original plan and buys the stock.
He had to. The tape was screaming, buy, just like it was before Harding called. He rides the stock up, manages to make back the 40 grand, and nets another 15,000 on top.
But if he had just ignored Harding from the start.
Oh, he would have made millions. It was the move of the year.
And the takeaway here isn't that Ed Harding is an idiot. It's that inside information is poison, even when it comes from smart, well-meaning people.
Exactly. Harding was looking at old info, or maybe just rumors. Livermore was looking at the tape. And the tape represents the actual money on the table right now. The tape knew the dividend was coming because the insiders were buying. Harding's gossip was lagging. The tape was leading.
This whole idea of the tape being the only truth, I want to dig into that because in 1906, we're not talking about some Bloomberg terminal.
No. We're talking about a literal ticker tape, a glass dome with a telegraph machine inside, spitting out this thin strip of paper with codes and prices.
And that strip of paper is your only connection to what's really happening. There's no CNBC, no Twitter.
It's just the paper. And Livermore's entire philosophy shifts after Saratoga. He realizes he needs a system, a way to verify what he hears against what the paper is actually saying. Which brings us to Deacon White.
Deacon S.V. White, one of the old guard.
A very sharp operator. And the story Livermore tells about him is just the perfect example of how to handle a tip.
Okay, so a breathless tipster runs into the deacon's office. He says, Deacon, you have to buy sugar stock. The president of the company, Havemeyer, is buying everything in sight.
The tipster is expecting the deacon to get all excited and start buying. Instead, the deacon turns to his clerk and says, sell 10,000 shares of sugar.
The tipster just about has a heart attack. He's like, no, I said he's buying.
But the deacon ignores him. He sells another 10,000. He dumps 20,000 shares onto the market in minutes.
So why is he doing that? He's not crazy. He's running a test.
It's a stress test. He's testing the market's breadth. If the president really is buying massive amounts of stock, there should be this huge bid underneath the price. The market should be able to absorb all of the deacons selling without the price collapsing.
It's like throwing a rock into a rushing river. If the current is strong enough, the rock just disappears.
Exactly. But if the price had crashed when he sold, it would mean there were no buyers. It would mean the tip was a lie.
But in this case, the market just swallowed the deacon's shares. The price stood firm.
So the deacon turns around, covers his shorts, and then buys 30,000 shares. He went long.
He used his own money to verify the rumor before he acted on it.
That is the difference between gambling and speculating. A gambler acts on the tip. A speculator tests the tip against the reality of the market.
Which brings us to the methodology. Chapters 6 and 7, they aren't just stories. Livermore actually lays out the rules he built from these failures. And the biggest one, the one that really trips people up, is buying on scale.
This is the rule that separates the pros from the amateurs. And it is psychologically just so incredibly difficult to do.
Yeah, because the standard amateur move is, I buy a stock at $100, it drops to 90, I think, great, it's on sale, I'll buy more to lower my average cost.
Averaging down. It feels so smart because you're getting a bargain. But Livermore says this is the fastest way to the poorhouse.
Why, though? If I liked it at 100, shouldn't I love it at 90?
No, because the market is telling you that you are wrong. If you buy at 100 and it goes to 90, your thesis is currently incorrect. The path of least resistance is down. Why on earth would you put more money into a losing position? You're fighting the tape.
So what does Livermore do instead?
He buys on a scale up. He'll buy a small lot at 100. If it goes to 101, he buys another lot. If it goes to 102, he buys the rest.
But he's paying more for the stock. That just feels like bad business.
He's paying for insurance. He's paying for confirmation. Every time the price goes up, the market is validating his idea. He's adding weight to a trade that is already working.
It's like watering the flowers instead of watering the weeds.
Exactly. He says, I don't want to buy cheap. I want to buy right. He wants to see resistance. He wants to see the stock fighting its way upward, proving there is real demand behind it. If a stock is easy to buy, if it's falling, it just means nobody else wants it.
This connects to his exit strategy, too. He has a rule about selling that I think is really counterintuitive for the average person. Sell when you can, not when you want.
This is a rule for the whales. When you are moving the kind of size Livermore moved, thousands of shares, you are the market. If you try to sell when the price is crashing, your own selling is just going to make the crash worse.
You'll get terrible prices.
Awful.
Yeah.
So you have to sell when the market is strong. You have to sell when the public is manic and desperate to buy. You need that liquidity to absorb your position.
You have to feed the ducks while they're quacking.
Crude, but that's exactly right. You have to sell into strength. And this requires immense discipline because you are selling precisely when the stock looks its absolute best. You're selling when everyone else is euphoric.
It all comes back to emotion, doesn't it? The Atlantic City hunch was about trusting an internal data process. The Saratoga disaster was about letting fear of being a sucker override that data.
It's the evolution of a trader. He started with subconscious competence, doing the right thing without knowing why. Then he lost his confidence in Saratoga. And finally, he built these rules, buying on scale, testing the market to reach conscious competence.
He stopped guessing. He stopped trying to catch every little wiggle in the price.
He stopped playing the game of what should happen and started playing the game of what is happening. He calls it the line of least resistance. If the market is going up, you buy. If it's going down, you sell. You don't argue with it, and you certainly don't let a friend talk you out of it.
It sounds so simple, but as we saw with the Saratoga story, it cost him millions to learn it.
It's the most expensive education in the world.
Yeah.
But hey, he paid the tuition so we don't have to.
So as we wrap this deep dive, I want to leave you with a challenge. Next time you're making a decision, whether it's in the market, in your business, even just a life choice, pay attention to where your conviction is coming from.
Ask yourself, am I looking at the tape? Am I looking at the hard, observable facts of the situation?
Or are you listening to the tip? Are you letting a narrative, a rumor, or maybe a persuasive friend override what you can see with your own two eyes?
Because if Jesse Livermore taught us anything, it's that the tip might make you feel safe, but the tape is the only thing that pays the bills.
And sometimes the tape tells you to sell even when the sun is shining in Atlantic City. Thanks for listening to The Deep Dive. We'll catch you on the next one.
Welcome back to The Deep Dive. Today, we are opening up a file that feels less like a financial history lesson and more like a masterclass in psychological warfare. But the war isn't against an enemy. It's against your own brain.
Right.
We're looking at the evolution of a legend, Jesse Livermore, or Livingston as he's called in the source material, and we're zeroing in on, well, the critical years of 1906 and 1907.
It is such a fascinating period because, when we usually talk about traders from this era, it's all about the boy plunger.
Yeah, the millions made in an afternoon, the champagne.
Exactly. But this is different. This is about the transition from being, a gambler to being a true speculator. And the price for that lesson.
Losing absolutely everything.
Everything.
That's actually the hook that grabbed me. I mean, we have this central conflict that just doesn't seem to make sense at first.
It's a paradox.
It is.
Mm-hmm.
How can a trader be absolutely 100% right about a market crash? He sees it coming, he's got the logic, and still go completely broke before it happens.
It sounds impossible, doesn't it? But that is exactly what happened in 1906. And to understand it, we have to look at how he was evolving. He started as a tape reader.
Just a scalper, really.
Yes.
Staring at the ticker, betting if the next tick is up or down.
Uh-huh. But the sources we have, they describe this really painful shift he makes to becoming a master of the big swing.
So let's unpack that.
Yeah.
Our mission today is to figure out the difference between, gambling on those little daily fluctuations and actually speculating on basic economic conditions.
And the mental discipline required.
Oh, the head game. The discipline to just sit tight when the entire world thinks you've lost your mind.
Which is so much harder than it sounds. And the story really kicks off with an epiphany, doesn't it? It starts in the summer of 1906 in Saratoga.
Right, the Union Pacific incident. He's on vacation, hanging out in a brokerage office, and Union Pacific is the hot stock. Everyone's talking about it.
Everyone, but he sees something on the tape.
What was it?
He's watching the price action, and he sees the price going up, but the volume is just massive. It tells him the stock is being accumulated by, strong hands.
Even though all the rumors were that the insiders were selling.
Exactly. The old Livermore would have listened to the gossip. But he ignored everyone in the room, and he trusted the tape. He bought the stock.
And the Abbey makes a killing because the dividend gets raised out of nowhere.
Yeah.
But the money wasn't really the point, was it?
No, the money was secondary. The real shift was this Declaration of Independence. He realized that listening to tips, even from really smart, well-connected people, was poison.
He talks about getting free from the opinions and surmises of other people. But hold on, isn't that a little arrogant?
Yeah.
I mean, if the smartest guys on Wall Street are your friends, ignoring them sounds like a recipe for disaster.
It does sound arrogant, but think about the psychology. He realized even his intelligent friends were biased. If they owned a stock, they were bullish.
Their hope was doing their thinking for them.
Precisely. They weren't analyzing, they were cheering. He realized he could read the tape better than anyone because he didn't have that speculative prejudice. He wasn't a bull or a bear, he was just an observer.
He has that great line, "I never argue with the tape." He says getting mad at the market is like getting mad at your lungs because you have pneumonia.
It's a perfect analogy. The market is just a force of nature. It doesn't care about you. And once he detached his emotions, he started seeing something bigger.
The big money?
The big money. It's not in the little ups and downs. It's not in outsmarting some manipulator on a Tuesday. The real money is in the big swing.
Okay, the big swing. Break that down for us.
Well, the big swing is this idea that the market is driven by fundamental economic conditions. The entire market moves together. You can't just focus on one stock if the whole economy is sick.
So if the underlying conditions are bad?
The market has to go down. No amount of manipulation can stop it forever. It has to run its course.
So he's moving from playing in the choppy water to trying to ride the tide.
He's finally seeing the matrix, the ocean, not the waves. But, having the vision is one thing. Having the bank account to back it up, that's another.
And that's where 1906 just absolutely crushes him.
The tuition of 1906.
He puts the new theory to the test. He's looking at the world map, and he sees a disaster brewing. The sources list the Boer War, the San Francisco earthquake.
It's global capital destruction. The Boer War. Millions in wealth just gone up in cannon smoke, as he puts it.
Right. And then the San Francisco earthquake and fire wipes out a huge American city.
And he makes this really smart economic point about feeding non-producing soldiers. All this capital is just vanishing, but the stock market in New York is at all-time highs.
A huge disconnect.
Yeah.
So he sees the storm cloud. He knows a crash is coming. Logic says, sell.
And he did. He started shorting stocks. And here's the tragedy. He was right about the logic, but completely wrong on the timing.
He uses that analogy that's so vivid. He sees a pile of dollars with a sign that says, help yourself.
The help yourself sign, irresistible.
So what does he do? He sprints toward it. He runs so hard that he loses his wind and collapses before he even gets there. He says, I should have walked.
It's such a painful lesson. He sprinted. By shorting the market way too heavily, way too soon, the market didn't drop right away.
It rallied.
It rallied, and those rallies just wiped out his margins. He ran out of money before the crash he predicted actually happened.
That's terrifying. To see the future, to know you're right, but get wiped out because you couldn't stay in the game long enough?
It's the ultimate tuition. The lesson he paid hundreds of thousands of dollars for was that being right isn't enough. Timing is everything.
A big swing requires a big line, and a big line requires a big balance.
You need the patience. You have to wait.
So he's broke, washed out, but not beaten. He rebuilds, and then we get to the signed confession. This is the turning point. What was the clue that told him, okay, now is the moment?
It wasn't a chart. It wasn't a tip. It was an ad in the newspaper.
A newspaper ad?
Yeah.
Seriously?
A very specific financial advertisement. The Great Northern and Northern Pacific Railroads announced a new stock issue. But the detail that caught his eye was that payments could be made in installments.
Installments, like a layaway plan for stocks.
Exactly. Now think about what that means. Great Northern was a blue chip stock trading at $330 a share. These were the most powerful companies in America.
And they're offering a payment plan.
It was a signed confession from the bankers. It meant they knew the money just wasn't there. It's like if a huge tech company today said, hey, you can buy our new phone, just pay us over 48 months because we know nobody has cash.
It just reeks of desperation.
It's a signal of a total liquidity crisis. The well was dry, and then right after that, another railroad, St. Paul, announces an issue with an even earlier payment date.
So it's a race.
A desperate race to grab whatever little cash was left on Wall Street.
So this time, he sees the evidence. He doesn't just guess. And he goes all in on the short side again.
But this time, he didn't sprint. He was anticipating the inevitable. And sure enough, the market started to get, as he put it, soft as mush.
But there's always that one stubborn stock, isn't there? The text mentions Reading stock. Everything else is crashing. But Reading is standing like the Rock of Gibraltar.
Ah, yes. Reading. It was being cornered by a pool, a group of wealthy operators just holding it up, trying to trap the shorts.
Yeah. And everyone told him, don't short Reading. You'll commit suicide.
But he did it anyway.
Why? Why pick a fight with the one strong stock?
Because of his new philosophy, the big swing. He believed that in a true bear market, caused by fundamental conditions, there can be no exceptions. If the ocean is draining, every single boat has to go down.
And he was right. He pushed it over the cliff, the pool collapsed, and the stock tanked.
So by February 1907, he has cleaned up, made a fortune. But, and this is so crucial, he didn't get greedy. He remembered the pain.
He took his profits and went to Florida's to go fishing.
Which brings us to that weird little anaconda interlude in Palm Beach.
This part is hilarious because it shows even a master can slip up when he gets bored. He sees a quote, Anaconda copper crosses $300 a share.
And his old tape-reading instinct just kicks in. He thinks, oh, it crossed the line, it'll pop for a quick gain. So even though he's bearish on the whole economy, he buys 8,000 shares. He goes long.
He breaks his own rule. It's like being on a diet and just eating an entire cake.
And the market immediately slapped him down. The stock went to 302 and just stalled. It didn't act right.
And this is the part that impressed me. He realizes he's wrong. What does he do?
He sells immediately at the market. He doesn't wait. He doesn't hope. He just cuts the limb off to save the body.
And the other trader there, Ollie Black, just laughs at him.
Ollie mocks him. He says, you'll be buying that back tomorrow at 320. Ollie is pure ego and hope. Livermore is pure discipline.
He lost about 30 grand on that trade, but he saved a fortune by getting out before the real crash.
His takeaway was just brilliant. If you're wrong, get right by ceasing to be wrong.
It sounds so simple, but it's the hardest thing to do.
It is. Admitting a mistake instantly.
So he dodges that bullet, and this sets the stage for the main event. The Panic of 1907, October 24th, the Day of Reckoning.
The description of this day is just chilling. It wasn't just a market decline. It was a cessation of business.
He describes the scene at the stock exchange. The money is just gone. Interest rates for borrowing hit 100, then 150%.
Think about that. The cost to borrow money is 150% interest, but even at that rate, you couldn't get it. Public lending just stopped.
And then we get that incredible image, the mouse in the bell jar.
That's a haunting metaphor.
He says the market was like a mouse in a glass jar with the air being pumped out. You just watch it gasping, eyes popping, suffocating. The oxygen was money, And there was no money.
It got to the point where there were absolutely no bids. You couldn't sell stock at any price. Total illiquidity.
If you had $1 million in stock, it was worthless. The machinery just stopped.
And this is where it becomes almost cinematic. The president of the stock exchange is ready to just close the doors. He goes to see one man, J.P. Morgan.
Who was, basically the central bank back then. There was no Federal Reserve.
He was it. The president walks into Morgan's office and says, "It's over." And Morgan, this imposing figure, tells him, "Go back, open the doors, there will be money."
But where did the money come from?
Morgan literally commanded the banks to use their reserves. The bank presidents were terrified. They said, "We're below our legal limits. We'll go to jail."
And Morgan basically said,
"Use the reserves. That is what reserves are for. Do it." He bullied the system back to life.
So while Morgan is trying to save the American economy, where's our narrator?
He's sitting on massive short profits. He's the king of the bears. And he realizes something profound.
He has the power right then to destroy the market completely.
If he had sent in an order to sell another 10,000 shares when there were no bids, it would have been the final straw. Total collapse.
And that's when a friend approaches him with a message, presumably from Morgan's people.
And it wasn't a threat. It was an appeal.
Please don't sell.
They appealed to his patriotism. But I have to ask, was it really patriotism that stopped him? Or was he just looking out for number one?
It's a bit of both, but mostly self-preservation. He realized a very simple truth. If the market collapses completely, if the exchange closes, who's going to pay him his profits?
You can't collect your winnings if the casino burns down.
Exactly. His paper profits were millions, but if the system breaks, there's zero. So he pivots.
In a split second, he goes from the biggest bear to the biggest bull. He covers his shorts, and then he buys 100,000 shares for the long account.
He bought the absolute bottom.
When no one else dared to even breathe. And that buying helped turn the market.
The source ends with this sentiment I really loved. He says he felt like king for a day. But it wasn't about the millions of dollars.
No, and that's the key. It was the realization that he had solved the puzzle. He wasn't gambling anymore. He had used logic and foresight to work for his money.
He'd moved from the boy plunger to a mature speculator.
It really is a story about tuition. He had to lose everything in 1906 just so he could have the discipline to win in 1907.
And that concept of tuition is something I think every listener should take away. The market charges you for every single lesson.
The question is, do you learn from the loss, or do you just pay the bill and make the same mistake again?
That is the question. And I want to leave everyone with one more thought. We look at this story from 1907, guys reading ticker tape, shouting on a floor, reading newspaper ads. Today we have algorithms, high-frequency trading, AI models digesting data in nanoseconds.
A completely different landscape.
But is it? My question is, in this algorithmic world, does the logic of the big swing still hold? Or has the tape, the short-term noise, finally won?
That's a great question.
Because it seems to me, whether it's 1907 or today, fear and greed are the one constant technology can't patch out. The mouse in the bell jar doesn't care if the jar is made of glass or silicon.
You're right. As long as humans or algorithms programmed by humans are pulling the trigger, the panic and the greed will always be there. The technology changes, but the psychology, that stays the same.
On that cheerful note, we will wrap up this deep dive into the mind of a legend. Thanks for listening, and we'll catch you on the next one.
Goodbye.